Good evening. I hope all have joined. Anyone else to join?
Good evening, ma'am. Good evening.
Good
Good
evening.
evening, ma'am.
Good evening. Good evening.
How are you, ma'am?
Fine. How are you?
Yes, good, ma'am.
Okay. Let us start the session.
Yeah, let's go.
Okay. Okay. Today we'll be discussing about working capital management. Have you learned it before? Working capital management?
No, ma'am.
No. Okay. Hope you know what is working capital. Working capital is the capital or fund required for meeting the day-to-day expenses of an organization. There are different kinds of organizations. We have service sector organizations, and there are manufacturing organizations. Okay, based on the output, we can divide service sector and we can divide the organizations into service sector and manufacturing sector. Okay, for service sector as well as manufacturing sector, could you please put it in mute? Okay, thank you. Okay, for both organizations like service sector and manufacturing organizations, we need working capital, right? Okay, what is working capital? Working capital is a minimum required capital for meeting the day-to-day expenses of an organization. And what are the day-to-day expenses? Okay, you think about a manufacturing organization. Okay, what are the day-to-day expenses required there? Okay, usually in a manufacturing organization, we purchase raw materials and we convert those raw materials into finished products, right? And in between, there is a work in process phase. And finally, you will get an output that is known as finished product, right? Okay, for that, we have to purchase raw materials regularly. Then what are the other expenses, day-to-day expenses for running an organization? You have to make payment for the laborers, right? Wages you have to pay, then electricity expenses. And if you're working in a rented building, you may have to pay rent, then water, electricity, then other expenses also you have to meet, right? These are the day-to-day expenses of an organization. Okay, we are discussing about working capital management. Working capital is the capital required for meeting day-to-day expenses of an organization. Okay, let us go into the details of working capital management. Okay. Working capital management, okay, the conceptually we can have two definitions, gross working capital and net working capital, which gross salary and net salary, which is higher, gross or net, which is higher, gross salary or net salary?
Gross.
Gross, right? Then from your gross salary, there may be deductions, right? Like tax, provident fund and all, right? Then net salary is what you are getting or what is your take home salary, right? And here also we have two concepts, gross working capital and net working capital. Okay, let us discuss these two concepts. Gross working capital means uh, the total of all current assets. Okay, hope you know what is current asset and current liability. Anyway, I'll tell you the difference. Current assets are those assets. Basically, they are the short-term assets such as cash and cash equivalents cash at bank, which can be liquidated within a year during an accounting period. Okay. What are the current assets? Current assets are those assets which can be converted into cash easily or which can be converted into cash within an accounting period. Usually, it's a term of 12 months. Such assets are known as current assets. And regarding assets based on the time frame, we can have long-term assets and short-term assets. The short-term assets are known as current assets. Okay. Do you know the examples of current assets? Current assets are either cash or cash equivalent assets. Okay, we can have short-term investments. You can have short-term investments for a period of less than 12 months, or you might have heard of accounts receivables. What is account receivable? Usually most of the sales are on credit terms, right? And credit sales you will be realizing after the credit period. But you are your credit period maybe within 1 year, maybe for 3 months or 40 days like that. And those are the things which we can convert into cash easily within a period of 1 year. Then let us discuss more about current assets and current liabilities. Then we'll come back to the concept of gross working capital and net working capital. Yeah. Uh, Current assets are the short-term assets which can be converted into cash easily. Then let us see what is a current liability. Current liabilities are short-term obligations which has to be paid within a year. Current liabilities are a company's short-term liabilities that are expected to be settled within a year or during an accounting period. Accounting period is a period of 12 months, right? And okay, let us go through the examples of current assets as well as current liabilities. Okay, first let us discuss the examples of current assets. Okay, you might have heard about petty cash, right? For making the day-to-day expenses, you may in your organization you may be keeping an amount of cash that is known as petty cash. That is to meet contingencies and meet the daily expenditures. Then you may be having cash in hand, uh, which is highly liquid and which is not deposited in the bank. And there may be cash deposited in bank also. Then you have accounts receivable. Accounts receivables, I have told you, like most of the transactions in an organization will be on credit terms, and even the sales will be on credit terms. Why we provide credit? Because your customers uh, may not be having the cash to make the immediate settlement, and so that you can give them a credit period so that they can make the payment on a later date. And when you go for purchasing your raw materials also, the suppliers may give you a credit, and that is known as uh, the opposite of accounts payable. Sorry, that is known as accounts payable. Accounts receivables is the amount you are expecting from your customers, and accounts payables are the amount you have to make on your credit purchases. Then in your stock, you may be having some inventory which is not yet sold, but you can sell it within a short period of time. Okay, that is also a part of current asset. Okay, what are the examples of current assets? It can be petty cash or cash in hand or cash at bank, accounts receivables, and stock. And stock can be of three types. You may be having a stock of raw materials, and there may be a stock of work in progress, and there may be a stock of finished goods. Why we consider a stock of raw materials, work in progress, and finished goods as current assets? Because you are running the business and you are uh, doing the manufacturing process regularly, so that you are confident that you can sell these inventory within a short period of time. That is why we consider stock or inventory as a current asset. Hope you got the concept of current assets. Current assets are those assets which can be converted into cash easily. These are the assets having high liquidity. Okay, what do you mean by liquidity? Liquidity means how easily you can convert an asset into cash. Current assets are having high liquidity. I hope it is clear. Then let us go to the concept of current liabilities. Yeah, these are the examples of current liabilities. Okay, what is a current liability? Current liability is a short-term obligation. Short-term obligation means you have to make those payments. You have to settle the liabilities within a period of 1 year. Such liabilities are known as current liabilities. These are the examples. Bank overdraft. Usually, it is a facility available for a business. Like if you, as individuals, we all have savings account, savings bank account, but we cannot have an overdraft, right? But for business person, they can avail overdraft facility. Okay, they can they can withdraw amount beyond their savings. They can have that facility. That is known as bank overdraft. But they have to make the payment within the stipulated period of time. Then another current liability is creditors. Creditors means you might have purchased raw materials on credit terms, and they will allow you buffer time to make the payment. And those suppliers to whom you have to make the payment are known as creditors. Then another current liability is your bills payables. You may have to make the payments of some bills like rent or something like that. Okay, you have to make the payment within a stipulated period of time. Such bills are known as bills payables. Then you might have taken short-term loans or short-term debt either from individuals or maybe from financial institutions. That is also a current liabilities because you have to make the payment within a period of 1 year. Then there may be some advances and deposits received in advance. That is also a current liability. Then outstanding expenses are also current liabilities. Then uh, okay, usually current liabilities and current assets are uh, a part of financial statements. You can see financial, hope you, my slide is visible to you, right? Yeah, I'm showing the slide of financial statement. You can see both liabilities as well as assets, and current liabilities are a part of liabilities. Okay, this is an example of balance sheet. In liabilities, you can see current liabilities. The first part of liabilities comprises of long-term liabilities. Then you can see short-term liabilities. Short-term liabilities are otherwise known as current liabilities. So you can see here under current liabilities, you can see sundry creditors, bills payables, outstanding expenses, bank overdraft, etc. Then on the asset sides, you can see the first item is current assets. Then you can see long-term assets or non-current assets or fixed assets. Okay, what are the items coming under current assets here? Cash at bank, cash in hand, sundry debtors, bills receivables, and stock. I hope you know the difference between sundry creditors and debtors. Creditors are those persons to whom you have to make the payment. Who is a sundry creditor? Can you give an example? Sundry creditor. Sundry creditors are the suppliers. You might have purchased raw materials from those suppliers, right? And who is a sundry debtor? Sundry debtors are the customers from whom you expect payments on a later date according to your credit terms, right? I hope these two terms are clear. Sundry creditors are the suppliers. Sundry debtors are the customers. Okay. If you have any doubt, please, you can ask. You can interfere in between. Hope it is clear. Can anyone respond?
Clear, ma'am. Clear.
Oh, it's clear, right? Okay. Can I proceed? Okay, we are talking about working capital management, and conceptually, there are two types of working capital: gross working capital and net working capital. To get an idea, we have discussed two terms: current assets and current liabilities. And let us come back to these two concepts: gross working capital and net working capital. Yeah, before that, okay, if you want, I'll explain accounts payable in detail. Accounts payable are the short-term liabilities of an organizations. Okay, this is the payment you have to make on your in purchase of the inventories. And usually, have you heard of a term like this? 3%, 25, net 30. Usually, you can enjoy the credit period given by the supplier, because suppose you might have purchased raw material today and you need to make the payment after 2 months. Okay, you will get 60 days uh, time to make the payment, right? Okay, you can enjoy these 60 days, and but from the part of the supplier, okay, they will be uh, preferring to get the payment before the 60 days, so that to promote the payment, they may give you an opportunity, like they may offer you a discount if you make a payment within. Okay, here in this example, net 30 means you are getting a grace period of 30 days for making the payment, and they are encouraging you to make the payment earlier. Okay, what is the encouragement? They are allowing you a third discount of 3%. You will get a discount of 3% if you make the payment within 25 days. Okay, that is the strategy usually adopted by the suppliers to make the payment earlier. Then, okay, we will be discussing about two aspects: how to optimize investment in current assets. And in today's class, we will be able to cover only the first point: how to optimize investment in current assets. And we will be discussing how should current assets be financed on a later session. Okay, today we won't be able to cover the second question here. Okay, for that, uh, how to optimize investment in current assets. Okay, for this, we have to understand what is gross working capital as well as net working capital. And okay, we'll come back to optimization after discussing the gross working capital and net working capital. Okay. Gross working capital is the total of all the current assets. And net working capital is the difference between current assets and current liabilities. Okay, hope you got it. What is gross working capital? Gross working capital is the total of all the current assets. Net working capital is the difference between current assets and current liabilities. Okay, you can calculate net working capital by adding all the current assets and deducting all the current liabilities from that. Hope it is clear. Then, okay, let us see how to optimize investment in current assets. Okay, now you know what is current asset. And what do you think for an organization? Is it good to have high investment in current assets or low investment in current assets? What is your opinion? High investment or low investment, which is good?
So,
Okay, we can have an optimum investment, right? That would be better. Okay, let us see how can we optimize the level of investment in current assets. Okay, for that, you have to avoid two danger points. Okay, what are the two danger points? You have to avoid excessive and inadequate investment in current assets. Okay, what are the two danger points? Avoid excessive investment in current assets and avoid inadequate investment in current assets. Okay, what you can do is you have to make an optimum investment in current assets. Okay, what happens if you have excessive investment in current assets? What happens? Okay, you have, for example, uh, inventory is a current asset, right? Inventory is a current asset. Okay, you have dumped a lot of raw material. What happens? Some products may be having seasonal demands, and you have dumped a lot of raw material. But for during the season where there is no demand for that product, and you have dumped a lot of raw material, what happens? It's a mere wastage of money, right? You're blocking your funds in raw material. Okay, that is why you should be careful. Like, don't make an excessive investment in current assets. And what happens if you have inadequate stock of raw materials? If you have inadequate stock of raw materials, uh, uh, you may not be able to meet the demand. If there is high demand for a product and you have low inventory, what happens? You may not be able to meet the demand, and you may also lose your customers also, right? Because these days, there are a lot of competition as well. If you are not able to provide a product, they may go to another supplier, right? So that, uh, please avoid excessive investment in current assets as well as inadequate investment in current assets. Okay, you have to optimize the investment in current assets. Okay. Inadequate investment affects firm's solvency position. Why? Uh, Sometimes you may not be able to meet the demands, and your customers may go to your competitors. And okay, what is the ideal ratio of current assets and current liabilities? Usually, the conventional rule is uh, to maintain the current assets twice the current liabilities. What is the conventional rule? Ideal proportion of current assets and current liabilities. Okay, it is good to have twice current assets than current liabilities. I hope it is clear. Okay, we are talking about how to optimize investment in current assets. Okay, avoid excessive investment as well as inadequate investment, and uh, uh, how to maintain the proportion of current assets and current liabilities. Current assets can be twice than that of current liabilities. Okay, so that you are in a safe position. Okay, you can meet the liabilities because you have double the size of uh, double current assets than your liabilities. Okay, you can easily meet the liability with your current assets. Then there is another term. Okay, so far we have discussed about working capital. And in working capital, there are two concepts: gross working capital and net working capital. Gross working capital is the total of all the current assets, and net working capital is the difference between current assets and current liabilities. And the next term we are going to discuss is about operating cycle. Okay. You just imagine a manufacturing organization. Okay, what will be happening in an organization, in a manufacturing organization? Okay, every organization we can consider as a system, right? Okay, what is a system? What are the parts of a system? Every system has three parts: input, process, and output. Okay, you can imagine an organization as a system having three parts: input, process, and output. And in a manufacturing organization, you purchase raw materials, and these raw materials will be undergoing some processes, and you convert these raw materials into finished goods. That is what is happening in a manufacturing organization, right? And the time taken for converting this raw material to finished goods, and finally finished goods you have to sell, right? Why we are making these goods? Because you have to generate income. How you can generate income? By selling the finished goods. And uh, most of the transactions are on credit terms, so that you have to wait till the completion of the credit period. Then only you will realize the cash, right? What is operating cycle? Operating cycle refers to the time an organization takes to buy goods, sell them, and receive cash from the sale of the goods. Okay, that is what is operating cycle. And Let us see how can we calculate the operating cycle of a firm. What is operating cycle? It is a time taken for uh, buying your raw materials and converting that to finished goods and finally to realize cash, right? Okay, let us see more about operating cycle. Hope you can see the slide. You can see a figure here, right? Okay, a cyclical uh, picture you can see. Okay, let us start from raw material procurement. Then after that, you will convert that to work in progress, then to finished goods. And finished goods will be usually will be sold on credit terms so that you are converting your finished goods to receivables. And you have to wait till the completion of the credit period. That's why uh, it will take a few more days to realize the cash. And you finally you have received the cash. Then what will you do? Your business is a cyclical process, right? You will not stop with this. You will again purchase raw material with the cash. Then you will convert that to finished work in progress, then to finished goods, then to receivables. Then you will again realize cash. Okay, then it goes cyclically. Okay, this is what is operating cycle. What is operating cycle? It is a time taken for purchasing raw materials and converting that to finished goods, then to cash. Then, like we discussed with respect to working capital, though we have discussed about two concepts like gross and net, right? Here also there are uh, two types of operating cycle: gross operating cycle and net operating cycle. Okay, now we are going to discuss about net operating cycle and gross operating cycle. Let us see the difference. Okay, hope you can see the figure here. Okay, you can see it starts from purchasing of inventory. Then after you can see a time a gap for making the payment, right? You are at the end of the credit period allowed by the suppliers, you are making the payment. And the time taken for purchasing of raw material and making the payment for your raw materials, that time period is known as account payable period. Then with that raw material, you will you will produce finished goods. Then uh, at this point, you will make the sales, right? And that the period between the purchase of inventory and sales is known as inventory period, or we can call it as inventory conversion period also. Then after making the sales, you have to wait till the end of the credit terms, right? And that period is known as accounts receivables period. And you can see another term here, cash cycle. Cash cycle is also known as net operating cycle. Okay, what is net operating cycle? Uh, Net operating cycle is the total time taken from purchase of inventory to realizing the cash. Then from that, you can deduct the accounts payable period. That is what is net operating cycle. The total time is known as gross operating cycle. And from gross operating cycle, if you deduct accounts payable, you will get net operating cycle. Okay, is there any doubt? Okay, we'll be discussing it in detail again. If you have any doubt, please ask. Okay. Let us discuss the operating cycle of a manufacturing company. Okay, you uh, think about a manufacturing organization. There you acquire raw materials, then you convert that to finished goods, and you will sell it later, right? Okay. In that sense, we can classify the operating cycle into three phases. Okay, what are the phases? The first phase is the acquisition of raw materials and resources. Then manufacturing, then sales. Okay, based on these three phases, we can have operating cycle can be explained like inventory conversion period and debtors conversion period. Okay, what is an operating cycle, or how can you calculate the operating cycle? The total length of the operating cycle of a manufacturing organization is divided into inventory conversion period and debtors conversion period. Hope you can see the formula here. Operating cycle is equal to inventory conversion period and debtors conversion period. Then, then here, inventory conversion period we can again divide into three. You know the process happening in an organization. We purchase raw material, then there is an intermediate phase between the conversion of raw materials to finished goods. What is that called? Work in progress, right? In that sense, we can have three steps in inventory conversion, like raw material conversion period, work in progress conversion period, and finished goods conversion period. So that we can write the formula like gross operating cycle is equal to raw material conversion period, work in progress conversion period, plus finished goods conversion period, plus debtors conversion period. Okay, that is a time taken for converting debtors to cash. I hope this is clear. This is what is gross operating cycle. Gross operating cycle is a total time taken from the purchase of raw materials, then to conversion, then to finished goods, then finally the conversion of debtors to cash. These are the intermediate steps: raw material conversion period, work in progress conversion period, finished goods conversion period, and debtors conversion period. Then, okay, I'll show you the calculation formula for finding each steps. First step is raw material conversion period. Raw material conversion period is obtained when raw material inventory is divided by raw material consumption per day. Okay, I'll be showing an example after this. Okay, please go through the formula first. What is raw material conversion period? Raw material inventory divided by raw material conversion per day. Okay, please see the formula. Raw material conversion period is equal to raw material inventory. Actually, it should be divided by raw material consumption per day. Okay, usually you will be given with the data for the entire year. That's why we have divided it by 360 days. For convenience, in most of the cases, we take 360 instead of 365. That's why the formula looks like raw material inventory divided by raw material consumption divided by 360. We have divided it by 360 for getting the raw material consumption per day. Is there any doubt till now? Okay, let us see the other steps also, similar steps. This is the first step, raw material conversion period. Then what is the next step? Work in progress conversion, right? Okay, let us go to that. Work in progress conversion. Okay, the formula is similar, like work in process or work in progress inventory divided by cost of production per day. That's why we are dividing it by 360. Work in progress inventory divided by cost of production divided by 360 days. Then like that we can find finished goods conversion period also. Okay, how will you get finished goods conversion period? Finished goods inventory divided by cost of goods sold divided by 360. Okay, can anyone respond? If someone has asked for overdraft example. Overdraft is what that is a facility available for a businessman. Okay, yeah, For individuals, usually we have savings account, right? Okay, from savings account, you can withdraw whatever you have deposited. Okay, you cannot, if you have deposited $1,000 or something like that, you can withdraw only $1,000. You cannot withdraw $1,001. But for a businessman, if they have a balance of uh, if they have a balance of $1,000, they can avail according. There will be a determined agreement between the banker and the business person. The banker will allow the business person, according to the credit worthiness of that individual, a certain limit, that like that they can have an overdraft facility, like even though they have a balance of 1,000, they can withdraw up to 1,500 or like that. Okay, but they have to make the payment within a stipulated period of time. That is what is overdraft. Hope it is clear. Then, okay, let us continue. Okay, we are discussing about uh, operating cycle, and in operating cycle there are two concepts: gross operating cycle concept and net operating cycle. What is gross operating cycle? It is a total time taken for converting your raw materials to finished goods, then to cash. Uh, and we can have categorization or classification like raw material conversion period, work in progress conversion period, and finished goods conversion period. Then there is one more component in gross operating cycle. What is that? Okay, now you have converted your raw materials to work in progress and finished goods, and you have made the sales. At this point of time, you have made the sales. Then, since it is a credit sale, you have to wait till the completion of the uh, credit period, right? And what do you call that time period or time lag? That is known as debtors conversion period. Okay, how will you calculate debtors conversion period? Debtors conversion period is equal to debtors divided by credit sales divided by 360. Okay, hope this is clear. Okay, then yeah, let us go to an example. Okay, we have discussed few formulas here. Now let us see how we can apply those formula. Okay, all of you, please listen. Okay, if you have a book or a paper and pen, you can write down the calculations. Okay, I'll explain how to do this problem to solve this. Okay, here you can see a statement of cost of sales, and you can see a few figures here, few items and figures here. Okay, what are the items you can see here? Okay, it starts from purchase of raw material, and it is clearly mentioned like it is a credit purchase. So that you have to make the payment after the completion of the credit term, right? Okay, purchase of raw material is there, opening raw material inventory is there, closing raw material inventory. Then uh, from these, if you have these three figures like purchase, opening raw material and closing figures, you can find out raw material consumed during that particular accounting period. Okay, how can you find that? Now we are going to calculate the raw material consumed during a particular time period. Okay, how will you get that? Let us see how to calculate that. Purchases plus opening stock minus closing stock. Okay, hope it is clear how raw material consumed is calculated. Purchases plus opening stock minus closing stock. Then you will get 4349 here. How did you get 4349? Please go through the figures. 4653 plus 523 minus 827. That is how we got 4349. Okay, if you have a calculator or you can use your phone to calculate this, okay, please check whether you're getting 4349. How will you get this? 4653 plus 523 minus 827. Hope you got the figure. Then we have,
Yes, ma'am.
yeah, Okay, thank you. We have a few other information. Okay, let us see how to make use of that information. We have direct labor, depreciation, and other manufacturing expenses. Okay, with these information, we can find the total cost. Okay, how will you get the total cost? Actually, so far you have calculated how much raw material is being utilized. Okay, how much is being utilized? 4349. And to that, you can add direct labor, depreciation, and other manufacturing expenses. And now you got the total cost as 5352. Okay, it's easy, right? 4349 plus 368 plus 82 plus 553. That is the total cost. Now, let us go to the next slide. Okay, now you have opening work in progress and closing work in progress. Okay, listen. Okay, inventory, there are three categories of inventory: raw material, work in progress, and finished goods. Okay, now we have calculated how much raw material is being utilized and how much cost is incurred for converting those raw materials to uh, work in progress. Okay, here in this slide, you can see opening work in progress and closing work in progress. With that, you can find cost of production. How will you get cost of production? Total cost plus opening work in progress minus closing work in progress. Okay, if you want, you can work it out. Total cost is 5352. Okay, please type this 5352 plus opening 185 minus closing work in progress. That is 325. Did you get 5212? 5352 plus 185 minus 325. I hope you got 5212. What is that? That is what is cost of production. Then we have few other information like information regarding your finished goods. Okay, we have opening finished goods as well as closing finished goods. Okay, how will you consider this? To the cost of production, you have to add opening finished goods and you have to deduct closing finished goods. Then what will you get? Then you will get cost of goods sold. Okay, you can try the calculation. Cost of production is 5212. 5212 plus 317 minus 526. How much you got? 5003. What is that? That is cost of goods sold. Okay. Now you have to meet other expenses, selling related expenses. Okay, what is that? Selling, administrative, and general expenses. Those expenses also you have to add to cost of goods sold. Okay, how much is that? 3.4, right? And by adding selling, administrative, and general expenses, you will get cost of sales. So how much is the cost of sales? 5307. Okay, hope this is clear. I'll go through the statement once more. Okay, we are calculating the expenses associated with three types of inventory: raw material, work in progress, and finished goods. Okay, this is how we prepare statement of cost of sales. Okay, first you have to find raw material consumed. How will you get that? uh, Purchases plus opening minus closing. Then to that you can add direct labor, depreciation, and other manufacturing expenses, and you will get total cost. And to this total cost, you can consider the expenses related to work in progress, right? Okay, how will you consider that? Total cost plus opening work in progress minus closing work in progress. Then you will get cost of production. Then you have to consider the finished goods inventory. Okay, cost of production plus opening finished goods minus closing finished goods. You will get cost of goods sold. And you have to add selling and administrative expenses. Then you will get cost of sales. Okay, hope the statement is clear. Then, okay, let us have a few more data. Let us discuss how to utilize these. We have sales, opening balance of debtors, closing balance of debtors, and opening balance of creditors and closing balance of creditors. Why we require these data? To calculate the gross operating cycle, you have to find what are the components of gross operating cycle. Basically, the formulas in inventory conversion plus debtors conversion. But we can categorize or we can calculate inventory conversion cycle separately, like raw material conversion, work in progress conversion, and finished goods conversion, plus debtors conversion. Okay, for calculating the debtors conversion, we need these details also. And okay, let us go through the calculation of operating cycle. I hope you can see the slide. Okay, here we have in the previous calculation, you have seen raw material conversion period as 4349. Raw material conversion is 4349. Then raw material consumption per day is 12.1. Then you will get raw material inventory. How will you get that raw material inventory? How will you get raw material consumption per day? Raw material consumption is 4349. It's for the entire year. Okay, so that how will you get per day value? Any doubt? Can you please put it on mute? Yeah. Can you please put it on mute? Can I continue?
Yeah, ma'am, you can continue.
Okay, thank you. Okay, here you can see raw material consumption as 4349. And how will you get 12.1? What is 12.1? This is the per day consumption. The total consumption for the whole year is 4349. How will you get per day consumption? You divide 4349 by 360. Can you please do that? 4349 by 360. Then you will get 12.1. Then you have raw material inventory as 827. And raw material holding days, how will you get that? Raw material holding days, here you can see 68 days. How will you get that? 827 divided by 12.1. Can you please try that? 827 is the total figure and per day consumption is 12.1. So that you can find the holding days as 827. 827 divided by 12.1. How much is that? Did you get 68?
68.34.
Yeah. You can round off it to 68 days. Yeah. Then, like that. Okay, let me go to the next slide. Okay. This was about raw material conversion. Then let us discuss work in progress conversion. The calculations are similar. Your cost of production is 5212. Then cost of production per day, how will you get this? Can anyone say the calculation? How did you get 14.5? The total cost of production for the entire year is 5212. Then how will you get per day figures? 5212 divided by 360. Please try that. 5212 divided by 360. Then you will get 14.5.
14.5.
Yeah, got it right. Work in progress inventory is 325. And you have to find the work in progress inventory holding days. What do you mean by this holding days?
Ma'am, you got 14.5.
14.5 you got?
How?
No, I'll tell you how to get that. Total cost of production is 5212. What does that mean? 5212 is the total cost of production for the entire year. You want to know the per day figures. Okay, how will you get that? 5212 divided by 360. 360. Did you get that? 14.5?
Yeah, it is round of 14.5.
Yeah, yeah. You can,
14.47.
yeah, you can round off it as 14.5. Yeah. Then work in progress inventory is 325. And you have to find work in progress inventory holding days. Holding days mean the time taken for converting work in progress to finished goods. Okay, that is 22 days. How will you get that? 325 divided by
14.5.
14.5. 325 divided by 14.5. Then you will get approximately 22 days. Got it?
Yeah, got it.
Yeah. Then what is the next step? Can you tell what would be the next step? Okay, we have discussed raw material conversion period. Then what is the next step? Work in progress. Then what would be the next step? Finished goods conversion period. Next is finished goods conversion period. Here you have the cost of goods sold as 5,003, and we need to calculate per day figures. How will you get that? How did you get
Divided by
13.9? Yeah, 5,003 divided by 360. You will get 13.9. And finished goods inventory is 526. You have to find finished goods inventory holding days. How will you get that? 526 divided by 13.9. Yeah, that is 38 days. Then,
Yeah.
listen, we are calculating gross operating cycle. What are the components of gross operating cycle? Raw material conversion period, work in progress conversion period, finished goods conversion period, and debtors conversion period. How will you get debtors conversion period? Okay, let us see how to calculate that. Collection period the data related to collection period is like credit sales 6,087, and you have to find the sales per day. How will you get 16.9? 6,087 divided by 360. You'll get
360.
16.9. Then debtors is about 735, and you have to know the debtors outstanding days. How will you get 43 days? 735 divided by 16.9. Then you will get 43 days. Okay. How will you calculate gross operating cycle? Raw material conversion period plus uh, work in progress conversion period plus finished goods conversion period plus debtors conversion period. Then you will get gross operating cycle. Excuse me, I'll show you the calculation. Gross operating cycle. Raw material conversion period 68. So you have the figure, right? 68 days. Okay, 68 days raw material conversion plus work in progress 22 days plus finished goods conversion 38 days, right? Then we have to add debtors conversion 43 days. That is what we have seen here. Raw material 68 plus work in progress 22 plus finished goods. You will get the total inventory conversion as 128 days. Total inventory conversion as 128 days. Then you have to add receivables conversion. That is what is debtors conversion, 43 days. Then what is our gross operating cycle here? 171 days. What do you mean by 171 days? That is the total time period taken for purchasing raw materials and converting that to finished goods, then to convert the credit sales to cash. You are taking 171 days for that conversion. Hope it is clear. Then there is another concept like net operating cycle. 171 is the gross operating cycle. And how will you get net operating cycle? Okay, there is one more thing like you have purchased raw materials on credit, right? Okay, suppose you purchase today and you have a credit period of 15 days, and you will be making the payment only on the 15th day, right? Okay, that is what is creditors outstanding days. Okay, let us see how to calculate that. Okay, please see the fifth item here. Uh, Credit purchase, you have made a purchase of 46.53 and purchase per day is 12.9. Okay, how will you get that? 4653 divided by 360.
60.
Then total creditors are 454. And you have to know your creditors outstanding days. Okay, you will get it by 454 divided by 12.9. Total creditors outstanding days are 35 days. Okay, you can enjoy 35 days credit. Okay, and let us see how we can make use of this figure. Okay, to get net operating cycle or the cash conversion cycle, you can deduct this from the total operating cycle, that is gross operating cycle. 171 is the gross operating cycle. From that, you can deduct 35. That is a payment deferral period or creditors conversion period. And finally, you got 136. What is that? That is a net operating cycle. Okay, hope it is clear. Okay, we have discussed the calculation of gross operating cycle as well as net operating cycle. Okay, hope it is clear. Okay, I think it is almost time. Okay, we can ask doubts if you have any. Okay, today we have discussed about the concept of working capital, and working capital can be of two types: gross operating cycle, gross working capital and net working capital. What is a gross working capital? It is a total of all current assets. Net working capital is the difference between current asset and current liabilities. And we have discussed about current assets, what are the components of current assets, what are the components of current liabilities. Then we discussed about operating cycle. And operating cycle has two concepts like gross operating cycle and net operating cycle. And we have discussed the formula as well as the calculation. Okay, is there any doubt?
No.
Ma'am, what is the payment
Pay,
deferral
yeah,
period?
payment deferral period is the time time allowed by your supplier for making the payment. Like you have purchased raw material from a supplier, and the supplier
Mm.
will give you a credit period of 15 days or 30 days like that. And you have to make
Mm.
the payment only after that credit period. That time, the time period you can enjoy from the supplier is known as payment deferral period. And why we are deducting that? Because all the other days you have to wait for getting your payment. But why we are deducting payment deferral period? Because that is the time you are enjoying, right?
Mm.
Yeah, that is why we are deducting payment deferral period. You can defer your payment for a
Mm.
period of 35 days. That is a good thing, right? The other things, the 171 days, 171 days you have to wait to get your payment back. But out of that, 35 days you can enjoy for making your payments, right? That is why we deduct that. And finally, you got net operating cycle as 136 days. Clear? Okay, I'll share the slides so that you can refer to the example once more.
Mm.
Okay. Okay, you can ask if you have any doubts, or we can wind up. Yeah. Thank you. Shall I stop? Thank you once again.
Thank you, ma'am. Thank you.
Thank you. Thank you.